The third quarter of 2015 is now history, and what a trying quarter it was. In looking back at the third quarter, we see not only a rough stretch for stocks and commodities, but also a period in which the financial narrative for the year changed. At the start of July, investors focused on whether or not the Federal Reserve would raise interest rates in September. By the end of the quarter, the evident economic slowdown in China had become the year's defining story. Key U.S. indicators waned as the quarter progressed, though the housing sector maintained its impressive sales pace. The stock market pulled back. The S&P 500 lost 6.94% in the quarter, which left it negative year to date. In September, the economy added a disappointing 142,000 new jobs. Annualized wage growth, which should be between 3 and 4%, remained low at 2.2%. The good news? In the ninth month of the year, headline unemployment was down to 5.1%, while the U6 underemployment rate dipped to 10%. Inflation remained a minor economic factor. By August, the CPI was up just 0.2% in the past 12 months, with the core CPI up just 1.8%. Consumer confidence and personal spending held up reasonably well as economic warning signals came in from abroad. Consumer spending and incomes both rose in July and August. As the quarter went on, the chances of the Federal Reserve raising interest rates seemed less likely. Indeed, the Fed made no move in September, but a dot plot forecast it published projected the federal funds rate at 0.40% by the end of 2015. The poor September's job report could alter that projection, as could the ongoing global economic and financial developments that the central bank referenced as cause to leave rates alone. Greece may have seized the headlines in the second quarter, but in the third quarter the big story was China. Its stock market exhibited extreme volatility and its economic indicators unsettled investors here and abroad. By July, the warnings were evident. Chinese exports had shrunk 8.3% in a year, imports had fallen for the ninth consecutive month, and the retail sales pace had reached a 15-year low. During the third quarter, the Shanghai Composite dropped more than 25%. China surprised investors by devaluing the yuan in August and responded to the correction by putting severe controls in the stock market. Economics question of China's official GDP and manufacturing PMI readings were being vastly overstated. Oxford Economics estimate China's 2015 GDP will be between 3 and 4%, and leading Swedish economics projects 3% growth, far removed from the 7% expansion forecast by Chinese government officials. Last quarter, the commodities market were not immune to losses either. Energy, crude, oil, agriculture, gold, silver, and other precious metals were down significantly. By August, new and existing homes were being brought up at a pace nicely exceeding year-ago levels. According to the National Association of Realtors, resales were up 6.2% annually in August, even after August turned out to be the second weakest month for existing home sales in the past 4.5 years. 32% of buyers were first-timers. A Census Bureau report showed new home buying surging 21.6% in the 12 months ending in August. Did home loans become more expensive in the third quarter? For the most part, no. Surveys showed a 30-year fixed-rate mortgage grew cheaper, with the average interest rate sinking from 4.02% to 3.86%, while the one-year adjustable rate mortgage increased slightly from 2.5% to 2.53%. Entering the fourth quarter, stock market investors has a central question. Can the year be salvaged? Can the S&P 500 possibly finish 2015 with an annualized gain? A fourth quarter rate hike by the Federal Reserve now looks much less likely, but even if the Feds avoid making a move, that will ease any anxiety about China's economy or the health of its stock market. Oil prices could remain low, with a major supply glut persisting at a time of reduced demand. Few investors are excited about this oncoming earnings season. Still, the fall could surprise to the upside. As recently as 2013, the S&P 500 gained 10% in the fourth quarter, and 2011 it advanced 11% in the last 3 months of the year. The bulls may be milling around now, but there is a chance they could run again before 2015 is over, though it will take some notable earnings surprises and encouraging headlines to truly set them loose. This concludes our video for the third quarter. As always, thank you for placing your trust in Life Plan Financial Group. We hope you have a wonderful fall season.